Most people think €50 per month is too small to matter. That's the first mistake, because the habit matters more than the amount. And if you get the structure right, with €50, you can scale it to 500 or 1,000 later without changing anything. But if you get it wrong at the start, even 500 won't save you. So the real question isn't if €50 is enough, it's how do I build a system that actually compounds? In the next few minutes, I'll show you exactly how I would invest €50 per month as a beginner investor. We'll cover what to avoid, what to prioritize, how to keep fees under control, and which simple ETFs actually make sense at this level. Because at €50, mistakes are magnified. One bad fee, one bad decision, and you've destroyed months of progress. I'm Daniel, a former London stockbroker and worked in finance for 10 plus years. I also publish stock market analysis to numerous investing websites, and in addition, I host one of the largest investor conferences in Central Europe. And if you want to see more videos like this, hit that subscribe button. Now, before you invest a single euro, there are 5 questions you need to answer. And this is not boring theory. This is what separates investors from gamblers. First, is this money above your last result savings? Never invest your emergency fund. Keep 3 to 6 months of expenses in simple savings accounts first. That money is not there to grow, it's there to protect you. Only invest money you won't need urgently. Because if you don't have that cushion and something breaks, your car, your fridge, or your job situation changes, you won't sell because you are scared. You will sell because you are forced to. And forced selling is how long-term plans collapse really fast. Second, what's your goal? Retirement in 30 years, house in 5, vacation next year. The goal determines everything else. Investing without a defined goal is like getting on a train without knowing the destination. You might move, it might be fun, but you won't necessarily arrive where you want. Imagine getting on a train in southern Italy, in shorts, in a shirt, and then arrive in Sweden where it snows. That's why goals are key. A 30-year retirement portfolio can handle volatility. A 2-year house deposit cannot. The same €50 behaves very differently depending on the mission. Third, what's your time frame? Under 2 years, avoid stocks. They are too volatile for short horizons. You could do everything right and still be down 20% when you need the money. 5 years or more, now stocks and ETFs become much more appropriate. The longer your horizon, the more risk you can absorb because the time smooths out volatility. Time is not just a helpful in investing tool, it's the entire engine. Fourth, what's your risk appetite really? Not what you say in theory, but how you will react in practice. You can watch your €50 turn into 30 temporarily without panicking or selling. Because at some point, that will happen. Markets drop, headlines get dramatic. And if scenarios make you uncomfortable, lean towards bonds or money market funds for part of your allocation. A slightly calmer portfolio you can stick with is far superior to an aggressive one you abandon. And fifth, what is your knowledge level? Be honest here. Follow the escalation ladder. Government bonds first, broad ETFs second, individual shares after that. And crypto comes last, and if you go there, Bitcoin before altcoins. Never start with instruments you don't understand. Starting at the top of the ladder might feel exciting, but that's exactly how beginners fall off. Now, let's move on and see your realistic options with €50 per month. You can apply the same principles if you invest 100, 200 euros, 400 Polish zlotys, or 500 Romanian lei. First, fractional ETFs. For most investors and beginners, this is the best starting point because it is the easiest to get started with. A simple word index ETF like FTSE All-World or MSCI World gives you instant diversification across thousands of companies. You don't need to buy a full share. You can invest exactly €50 through brokers that support fractional purchases. That means no leftover cash sitting on the side uninvested. Just clean, automatic exposure to global markets. This is the most efficient way to start building wealth with small amounts. Second, fractional shares. Once you're comfortable with ETFs and understand how markets move, you can add individual companies. Maybe you found a publicly traded company that you believe in long term. But this only comes after you've built a core. And again, only through brokers that allow fractional investing. Otherwise, €50 limit you might think is too much. Individual shares are optional. The core ETF is not. Third, government bonds. Lower risk, more predictable returns. And some countries offer a very attractive tax-free status as well. In Romania, for example, Tezaur government bonds are now available online via gisaul.ro with simple debit card purchases. The minimum is around 1,000 lei, so you need to save a few months and then save a little bit, but they are tax-free. In Hungary, for example, there are similar state bond programs available through the online treasury system for Hungarian tax residents, and they are also tax-free. And if you want something ultra simple, Revolut even offers fractional shares and fractional access to government bonds with no minimum. You can buy small pieces of bond yielding around 2 to 3% per year, Bulgaria, France, Italy, European Union government bonds. You can also invest in money market ETFs with similar safe and predictable returns. And finally, crypto. Obviously, higher risk, higher volatility. If you go down on this route, start with Bitcoin only. No altcoins, no leverage, and definitely not your entire €50. Crypto should be a small piece of a broader portfolio, not the foundation. Treat it as a satellite exposure, not your core strategy. Now, here is where beginners overcomplicate everything. They think they need multiple ETFs, a bit of tech, a bit of emerging markets, maybe a dividend ETF for income. No. With €50 per month, your superpower is consistency, not diversification. One accumulating global ETF. Automatic investment, same day, every month. That's it. You're building the behavior first. You are not trying to outperform hedge funds. When you have a portfolio of 10, 15,000 euros, you can start managing it more actively, but until that point, stick to a basic strategy. And here's the reality of €50 per month. Fees matter more than returns. If your broker charges €5 per trade and you invest 50, that's 10% gone instantly. You are not compounding, you are recovering losses. So before we even decide about what to buy, you must choose the right vehicle. At this level, you optimize for low costs and low friction. Not fancy features, not brand names, not your bank's glossy app. Classical banks are usually far too expensive for small monthly investing. You need platforms that offer zero commission ETF savings plans and support fractional investing, so every euro actually goes to work. Now let's talk about brokers, because at €50 per month, this decision is not secondary. It's critical. Fees are everything. Luckily, there are several low-cost options in Europe. Trading 212 is popular for a reason. No commission, fractional shares and ETFs, very simple interface. For beginners, it removes friction. Scalable Capital is another strong option, especially if you want automated ETF savings plans. It's available across Germany, Austria, France, Italy, Spain, and the Netherlands. You said it once, and it runs. The Giro offers very low fees and huge selection through the interface, but the interface is slightly more complex than the previously mentioned ones. But don't forget to mention Revolut, because Revolut is convenient if you want everything in one place. Fractional shares, ETFs, bond, even crypto, but you need to check their fees carefully because they might be a bit higher. The good news is that you can also have a bank card with Revolut and manage your everyday finances there as well. AxTB offers zero commission trading up to 100,000 euros and is very beginner friendly. And Lightyear is another clean, low commission platform with simple, modern interface. So as you can see, you have plenty of options to choose from. And what should you avoid? Brokers with inactivity fees, brokers with high FX conversion fees if you're buying, let's say, a dollar-denominated ETF, and anything charging more than €1 or €2 per trade at this level. Classical banks are usually bad choice here. Their commissions might not look dramatic first in absolute returns and absolute terms, but relative to €50, they are destructive. If you've ever invested before and if you have €50 per month to put to work, the simplest, low-drama approach is this. Open a low-cost brokerage account, set up an automatic monthly investing into, let's say, a global ETF like MSCI World or similar broad word fund, and don't touch it. That's genuinely it for year one. No tactical moves, no reaction to headlines, no trying to be clever. Once you're comfortable watching the numbers go up, go down, without any stress, and this part is really important, you can start thinking about the next steps. Maybe small bond allocation, maybe a slight regional tilt, but only after you've proven yourself that you can stick with a plan. Let me know in the comments which low-cost broker are you currently using or planning to use if you are just starting out. Also, don't forget to hit that subscribe button. See you in the next video.